Good morning. This is Larry McMillan with a market update on Monday, June 1st, before the market opens. So the rally continued last week despite a lot of other things not looking so great, but the momentum by the short-term S&P is quite amazing. And so we're still on a short-term buy signal here. We don't really have any sell signals from our indicators. However, there are some overbought conditions beginning to appear. As far as the S&P chart goes, a close below 2920 would be some cause for concern, and we would at that point begin to take some bearish positions. There's a gap that begins there, runs down to 2865. There are a couple of other support levels below that too. If they were taken out, then would become a problem. But for right now, an easy mark is 2920. As long as we stay above that on a closing basis, the upward momentum is still in place. The equity-only put-call ratios are very overbought, but still on buy signals. So they continue to decline. The computer analysis programs that we have that look at those ratios are still saying they're not rolling over to sell signals yet. So the put-call ratios are still bullish. Breadth, however, is continuing to be weak in the face of this rally. For example, on Friday, due to a late rush of sort of panic buying, S&P closed up 15 points, but breadth was negative. So that's not good. But still, we've had this along the way, and it hasn't caused a problem yet. Usually, though, this is a warning sign that there's something, a negative divergence that is not going to be easily resolved. But for right now, we don't have a sell signal from the breadth oscillators either. Volatility continues to hover between 27 and 30. VIX is still not broken down yet. We published a study on Friday in our the Option Strategist newsletter that showed how VIX volatility, historic volatility, behaved in the big rally of between 1929 and 1930. So it's really quite similar to now, and it went flat for a while there, and then went down again. So here, VIX is still holding near 27. It's above its 200-day moving average. So those are intermediate term negative things. On the positive side, VIX has the spike peak buy signals of the recent weeks, and those are still in effect. The term structure is still kind of flat, so that's not bullish yet either. But in summing, it's basically the same thing we've been saying for a while. Short-term bullish, intermediate-term bearish. We're staying on alert for a break of support by S&P. I think that would be a significant development. On the other hand, if VIX closes below its 200-day moving average and SPX closes above its 200-day moving average, then there's more bullishness to come. So we'll let the indicators decide which way we're going to take. They're going to take us. I invite you to visit the website optionstrategist.com, where we have a number of special offers going on right now, and of course our newsletters have continued to perform well throughout this year. So thanks for listening, and have a good week trading.